Two major mistakes out there that people make in their stock market portfolios that I don't want you to make. Two caveats though. Number one, I'm mostly talking about individual stock picking here. I'm not necessarily talking about buying an index fund or a mutual fund. I'm talking about individual stock picking. That's number one. Number two, we're talking about long-term investing. I'm not day trading. I'm not swing trading. I'm not trying to get in this week and out next week. Not trying to time any short-term price movements. I'm talking about companies that I believe are going to perform very, very well in the medium to long term, somewhere between 1 and 10 years. Yes, that's a large range, but a 1 year would be a really short hold for me, and a 10-year would be a pretty long hold for me, right? So I took about a week off of recording, and in that week off of recording any YouTube videos, I was just thinking like, what do people really need to hear? Not what they want to see, not what they want to hear, but what do they need to hear? They need to hear about the mistakes they're making. So that's why I'm making this video, okay? But before we dive into all that, if you're new here, thank you for being here. I'm Austin. I'm a co-owner of cloudmusicsuite.com. I'm also a stock market investor, okay? If you're new to the channel and you're not subscribed, go ahead and subscribe, become one of those 2,400 people or so, and consider joining the Patreon with the pinned comment in the description area. As a thank you for doing those things. Here's some pictures of my animals. My dog, her name's Penny, and then my two cats, Millie and Luna. Millie's the gray one, Luna's the brown one. Hope you enjoyed all that, okay? Let's dive into it. So, mistake number one that people make whenever they're opening a position, they don't have a very clear and specific plan. I always ask people in my comments when they say they're buying this stock or they're buying that stock or they're holding this stock, hey, what's your share goal with that stock? The share amount that you have in mind for how many shares you want to own. Maybe you're buying PayPal stock because you feel like it's a really good opportunity. How many shares do you want to hold? What percentage of your portfolio are you trying to go for in that particular stock? And how long a period of time are you going to be accumulating shares until you get to that point? Those two things by themselves can help you a whole lot in terms of getting the price improvement if you happen to buy a stock a little bit higher, a little bit overvalued. Maybe you bought PayPal in the 70s or in the 60s. Now we're in the 50s, right? If you bought a few shares to open your position at first, and then you bought a little bit more when it dropped, you bought a little bit more when it dropped, and you knew you were going to be buying over a 6-month period of time, you would be able to get a really nice price improvement on those shares that you bought because you didn't go all in one day. And another thing is, how long are you wanting to hold the stock, and what type of return are you expecting based on your research that you've done, based on the current valuation and where you believe the cash flows are going, where you believe the revenues are going, where you believe the profits are going over the coming quarters, coming years, coming decade, etc. What this is going to do for you, it's going to take all the guesswork out of it. As long as you've researched the company well, you know how many shares you want to own or what percentage of your portfolio you would like it to be, you know how long you're going to be buying for, and you have a goal of what type of return you're trying to get from that stock. And make sure you're realistic. Not every stock's going to be a 5x, right? So not every stock you buy should be like, oh yeah, I'm definitely going to get a 5x on this. So be realistic about the goal that you have. But what this is going to do is, if you buy PayPal and it runs up 20%, you're probably not going to sell out if you fully believe, based on your research, that you're going to get a 2x on your money. Or maybe you were going for a 75% gain on your money over an 18-month, or 2-year, or 3-year span. That would be very, very, very respectable. But if you just sell out once you get that 20% gain, you've lost out on the really, really big gain that you could have gotten if you were to hold those shares and be a little bit more disciplined. So my advice would definitely be to formulate a plan. In my notes on my phone, and I actually write it down on a piece of paper as well, I either say how many shares I want to hold or what percentage of my portfolio I want it to be. I say how long I want to be buying that stock for. Do I want to be accumulating shares for 3 months, 6 months, 9 months, 12 months, even longer than that potentially? And I also write down, based on the current valuation and where I see the revenues going, where I see the net income going, where I see the cash flows going, what type of return I believe I'm going to get over a certain period of time. Does it always work out perfectly? No. Does it work out really, really well most of the time? Yes, as long as I'm researched and I'm okay with parting ways with a stock if the fundamentals start to go bad. Anytime the fundamentals start to go bad with the stock, it's time to consider getting out. As long as the fundamentals are improving, even if the stock price is dropping, that's not a bad thing. That's actually a good thing, because now not only are you getting a business that has fundamentals improving of the underlying business, but you're also able to buy it at a lower price. That's the ideal situation. If we have the price dropping and the fundamentals are getting worse, of course the price should be dropping. That's a stock that hasn't earned respect from the market or is losing respect from the market. That's why that stock price is going down. There's so much selling pressure on it. Having a plan kind of gets the emotions out and takes the guesswork out of things. So that will be number one. Don't make the mistake of not having a plan whenever you dive into a stock. Then number 2 is not knowing what you own. I'm not just talking about what the business model is. I'm not just talking about how they get their money. I'm not just talking about the management team, but I'm talking about keeping up with this stock on a quarterly basis. What is going on with the underlying business? Are you listening to the conference call? Are you looking at the quarterly reports? Whenever they report their annual report, are you reading the annual report? There's a lot of words in there. You got to figure out what things are important to you inside of these quarterly reports, inside of these press releases around quarterly earnings, and decide, do I believe the fundamentals are getting better with this business, or do I believe the fundamentals are getting worse with this business? It's not just, hey, they reported earnings, stock price went up, woo, awesome, great. Sometimes the stock price goes up when, in my opinion, it shouldn't go up. Sometimes the stock price goes down when, in my opinion, it shouldn't go down. Have their revenues done really well over the past few years as it relates to revenue growth? Okay, good. What's their guidance looking like? What did the management team say about next year's guidance? How are the net income growth numbers looking? Is the net income growing faster than the revenue itself? Meaning, is the business becoming more effective and more efficient at running the business, or are they just having net income increase because revenue is increasing? If net income is not increasing faster than revenue, they've got some spending problems on their hands, right? Those are just a few examples of things that could be happening that you wouldn't know are happening if you're not checking out those quarterly reports and you're not staying up on the press releases that the company's required to report every single 3 months in the annual report every year. So the very short version of the 2 mistakes I don't want you to make in the market is, number 1, make sure you're not the guy or girl that goes in with no plan with the stock. And then number 2, make sure you're not the person that buys the stock and then doesn't keep up with the underlying fundamentals. And then you may be shocked that you look back at a stock that you bought 3 months ago, 6 months ago, a year ago, and it's down 30, 40, 50, 60%. And you might be saying, like, why does the stock keep going down? If you knew, because you were checking out those underlying fundamentals, that the fundamentals were weakening and weakening and weakening, and you probably should have gotten out a long time before you did, right? I definitely had to learn both of these lessons the hard way. That's why I'm making this video, because I don't want you to have to learn them the hard way either. I want to know if you've made these mistakes or any other large mistakes you've made in the stock market before. Let's get some conversation going on down there. I appreciate you being here in a major way. I hope you got some value out of this video. Thank you so much. Have an amazing day.